If you're over 60, there's one financial habit, one you may think is smart and safe, that could quietly erase decades of savings overnight. No market crash, no scam, no warning. You go to bed believing your nest egg is secure, and by morning, your portfolio has quietly lost tens of thousands. As a financial advisor with over 25 years in senior wealth management, I've seen too many retirees fall into this trap. Not because they took wild risks or chased fads, but because they mistimed their investments. Yes, timing, not the stock you pick, not the fund you hold, is often what destroys senior portfolios. And it happens to good, cautious investors every single day. If you've ever shifted money into bonds after a market dip, pulled out of stocks too soon, or jumped into an annuity right after a market rally, this message could save your retirement. Because the truth is, mistiming, buying high, selling low, or reallocating at the wrong phase of the cycle, can quietly rob you of compounding returns you'll never get back. Today, I'm going to show you 3 common timing mistakes seniors make, how they happen, and how to avoid them before it's too late. I'll also share stories of real clients who made these choices, and what it cost them. Don't forget to like this video and subscribe for honest, no-nonsense senior wealth advice. Now, let me start with the most painful story I've seen, a gentleman who did everything right, except for one crucial moment. His name was Robert. He was 68, a retired engineer, thoughtful and disciplined. He'd built a $900,000 portfolio over decades. After the 2020 market rebound, he felt uneasy. News headlines warned of recessions, inflation, and overvalued markets. So, in 2021, he moved nearly 70% of his stocks into cash and short-term bonds, thinking he was being prudent. "I just want to protect what I have," he told me. For a while, he felt safe. But as inflation soared and markets recovered faster than expected, Robert missed out on 2 years of strong gains, over 25% growth. By the time he tried to get back in, prices were already higher. His $900,000 could have grown to $1.12 million. Instead, it sat stagnant at $880,000 after inflation. He didn't lose money outright, but he lost time, the one thing no retiree can buy back. That's the invisible danger of mistimed moves. You don't see a big red number flashing on your statement. The loss hides in what you didn't earn, in compounding that never happened. Over a 10-year retirement, missing just 2 strong recovery years can reduce your income by hundreds of dollars a month. And the worst part? Most seniors make this move believing it's safe. They wait for the dust to settle, not realizing the best returns often come after fear peaks. If you're retired or near it, and you've ever said, "I'll get back in when things feel better," you may already be making the same mistake Robert did. The market doesn't wait for comfort. It rewards discipline, not emotion. In Part 2, I'll show you the second timing trap, one that hits conservative investors hardest. It's the mistake of locking in safety at the wrong time, and how it quietly destroys your long-term income. I'll also share the story of a retired teacher whose well-meaning shift to fixed income left her struggling just 5 years later. If you're finding this eye-opening, type timing in the comments so I know you're with me. Because what I'm about to share next could be the difference between running out of money at 80 or leaving a legacy at 90. The second mistake I see far too often, and the one that quietly devastates even the most cautious retirees, is what I call the safety lock. It happens when seniors move too much of their portfolio into safe assets like CDs, fixed annuities, or long-term bonds at precisely the wrong moment. It feels smart. It feels stable. But in reality, it can quietly choke off your portfolio's ability to grow and keep pace with inflation. And that gap, over just a few years, can mean the difference between comfort and compromise in retirement. Let me tell you about Marjorie, a 72-year-old retired teacher from Florida. She was one of the most organized clients I've ever met. Neat files, careful notes, meticulous budgeting. After decades of saving, she retired with about $600,000. When the market dropped in 2022, she panicked. Her account statement showed a loss of nearly $70,000 in just 6 months. "I can't afford this," she told me, her voice shaking. "I'm too old for risk." So she did what most retirees do when fear takes over. She sold nearly all her equities and moved everything into fixed-rate products. A 5-year CD paying 4%, some long-term bonds, and a fixed annuity that promised no market losses. It sounded responsible. But what Marjorie didn't realize was that she had locked her money in at a moment when inflation was surging at over 7%. Her safe return was falling behind every single month. After just 2 years, her real purchasing power had dropped by nearly 10%. Groceries cost more, her Medicare premiums went up, and the 4% she thought was stable income couldn't stretch as far. She didn't lose money on paper. But she lost ground, quietly, relentlessly. By the time her 5-year CD matured, prices had climbed so much that her fixed income couldn't cover the same expenses. "I feel like I'm moving backward," she told me. And she was. Her savings were frozen in time while the world moved forward. That's the cruel truth of the safety trap. Inflation doesn't care if your money is safe. It eats away silently, $1 at a time. And when you lock in low yields during high inflation or early in retirement, you remove the one weapon that can fight it: growth. Stocks aren't just for the young, they're for anyone who needs their money to last decades. And for many seniors, that's exactly what's required. I've seen this pattern repeat across hundreds of portfolios. A retiree sells after a market drop, moves to fixed income for peace of mind, and ends up eroding the very nest egg they were trying to protect. What feels safe today becomes risky tomorrow. The portfolio can't recover because it's no longer participating in the rebound. Let me explain why this timing is so damaging. Markets move in cycles. Historically, some of the strongest recoveries occur within the first 12 to 18 months after a major decline. If you exit during the fear and sit in cash, you miss the rebound that rebuilds your wealth. A portfolio that drops 20% needs a 25% gain to break even. But if you've locked into 4% returns, you'll wait years, sometimes decades, to catch up. And most retirees don't have that kind of time. Another danger: interest rate shifts. When Marjorie bought her long-term bonds, rates were climbing. As they rose higher, the value of her bonds fell. So even her safe investments weren't immune. She was earning modest interest, but if she needed to sell early, she'd take a loss. Safety is never absolute. It always carries trade-offs. The emotional pull toward stability is understandable. After 60, the focus shifts from building wealth to preserving it. But preservation without growth is a slow leak. You don't feel it day to day, but year after year, the power of compounding turns against you. You end up with more fear, less flexibility, and a shrinking lifestyle. Here's the simple truth: safety isn't about avoiding risk, it's about managing it. The right mix of growth assets and income vehicles can protect your portfolio while still giving you a fighting chance against inflation. But timing that shift, knowing when to rebalance, not retreat, is everything. If you're listening to this and thinking, "I just want to sleep at night," remember that comfort today can mean struggle tomorrow. A portfolio needs balance, not paralysis. You don't need to gamble, but you do need to stay in the game. Ask yourself, are you earning less than inflation right now? Has your safe money actually grown in purchasing power? If the answer is no, it's time to reassess. Talk with a fiduciary advisor who understands sequence of returns risk, inflation hedging, and income layering. Don't wait until your dollars lose value before taking action. Marjorie eventually diversified back, slowly, carefully, reintroducing dividend-paying stocks and inflation-protected bonds. It wasn't easy, but within 2 years, her portfolio regained its footing. "I wish I'd never left the market," she said. "I thought I was protecting myself. I was really trapping myself." Her story is a reminder that in retirement, fear can cost more than volatility. In Part 3, we'll uncover the third and most deceptive timing error: the chasing comfort trap. It happens when retirees move money into investments that sound safe because they promise high yields or guaranteed returns, but behind the curtain, they're tied to risky timing cycles that can devastate your income when you need it most. I'll share how one couple's well-intentioned move into a guaranteed income product ended up cutting their cash flow in half. It's a story every retiree should hear before signing anything. The third mistake that wipes out more retirements than almost any other is what I call chasing comfort. It starts innocently. You see a product advertised as guaranteed, steady, or market-proof. Maybe it's a fixed index annuity, a structured note, or a fund promising high monthly income with no losses. It sounds like the perfect middle ground: safe, predictable, and rewarding. But behind that comfort is a hidden timing trap that locks your money away during the wrong cycles and caps your growth when you need it most. By the time you realize what's happened, inflation and opportunity cost have already taken their toll. I'll never forget Daniel and Rose, a retired couple in their early 70s. They'd spent a lifetime working hard, saving carefully, and avoiding debt. Their dream was simple: keep $1 million invested, live off $40,000 a year, and never touch the principal. When markets turned volatile in 2022, they grew anxious. "We don't want to lose another dime," Rose told me. They attended a free retirement seminar that promised guaranteed lifetime income. The presenter used glossy charts showing steady returns and no downside risk. It sounded safe. Within weeks, they rolled over $700,000 into a fixed index annuity paying 5% income for life. At first, it felt like a relief. Every month, they received a check. But over time, the cracks began to show. The income was fixed. It never grew with inflation. Their spending needs rose each year while their payout stayed the same. 5 years later, their grocery bills were up 30%, utilities higher, medical costs climbing, and their guaranteed income no longer covered the basics. Worse, their principal was locked away. If they wanted to adjust or move funds, heavy surrender charges made it impossible. They'd traded flexibility for false peace of mind. The timing of their purchase compounded the problem. They bought in when interest rates were still rising, which meant newer products offered better payouts just months later. But they were stuck in the older contract. And because part of their money was pulled from growth assets, they missed a significant market rebound. By avoiding short-term volatility, they locked themselves into long-term erosion. This is the silent cost of chasing comfort. These products often sound like protection from market swings, but they come with rigid structures, limited liquidity, and caps that can rob you of future compounding. Many fixed index annuities, for example, credit gains only once a year, based on specific timing windows. If markets rise mid-year and fall by the anniversary date, you get nothing, despite a strong overall year. That's how timing quietly works against you. You think you're safe, but you're at the mercy of calendar quirks and opaque formulas. Daniel once told me, "We thought we were buying peace. We didn't realize we were buying handcuffs." It broke my heart because they weren't reckless. They were careful, diligent, and trying to protect their life's work. But they mistook predictability for protection. And that's the essence of this trap. When you prioritize comfort over strategy, you give up the one thing that makes wealth last: adaptability. The financial world preys on fear, especially among retirees. After every downturn, you'll see headlines pushing guaranteed income and market shields. The timing is deliberate. When emotions are high, logic fades. But what most don't realize is that these guarantees come from your own money. The insurer isn't performing miracles. They're trading your potential growth for fixed promises built on conservative assumptions. You could achieve similar or better outcomes with a balanced portfolio and a disciplined withdrawal plan, without locking away your future. Now, I'm not saying all annuities or income products are bad. For some, they play a role. But they must be chosen at the right time, in the right amount, and with full understanding of their limits. Buying one out of fear, right after a market drop, is like closing the barn door after the horses are gone. You freeze losses, miss recoveries, and let inflation quietly bleed your buying power. If you've been tempted by offers of 5%, 6%, or even 7% guaranteed returns, look closely. Many of those numbers refer to income calculations, not actual growth. The real value of your money may be flat or declining. And once you sign, surrender periods can last 7, 10, even 12 years. Timing that decision wrong can trap you for an entire market cycle. Daniel and Rose eventually adjusted their plan. They left the annuity income in place but shifted their remaining cash into a flexible income strategy tied to dividend growth and short-term bonds. It gave them room to breathe again. But they still carry the regret. "We thought safety meant staying still," Rose said softly. "Now we know it means staying balanced." That's the lesson. Safety is not a product, it's a process. It's built on diversification, rebalancing, and the patience to ride through volatility. The biggest danger isn't a market crash, it's making permanent decisions in temporary storms. Chasing comfort may feel good today, but it often steals tomorrow's security. In the next section, we'll tackle a fourth mistake, one that doesn't come from fear, but from overconfidence. It's the timing genius trap, when seniors believe they can outsmart the market by jumping in and out based on headlines or gut feelings. I'll show you how even a few mistimed moves can destroy decades of compounding and share the story of one retiree whose smart moves cost him over $200,000 in missed gains. If you've ever tried to wait for the right moment, you need to hear what's coming next. The fourth mistake is the one most investors believe they'll never make, yet it's one of the most common among retirees who follow the markets closely. I call it the timing genius trap. It happens when a well-intentioned investor convinces themselves they can outsmart the market. They watch the news, follow financial pundits, read predictions, and believe with enough information they'll know when to move in or out. It feels rational, even responsible. But the truth is, this confidence often leads to missing the very gains that sustain a portfolio through retirement. Let me tell you about Frank, a 70-year-old retired accountant. He was sharp, analytical, and loved tracking market trends. He read every financial magazine, watched the business channels daily, and followed half a dozen newsletters. He'd call me after each major headline. Rates are rising, the Fed's tightening, I think it's time to reduce stocks. Or, recession's coming, maybe we should sit in cash for a while. Frank believed timing was a skill, something he could perfect through research. But what he didn't realize was that every time he tried to avoid a downturn, he was also stepping out before the recovery. In early 2020, when markets began to wobble, Frank moved half his portfolio to cash. Just weeks later, the pandemic crash hit. He felt vindicated. "I saved myself a fortune," he said proudly. But within months, markets rebounded faster than anyone expected. By the time Frank felt safe enough to re-enter, stocks were already up nearly 40%. He avoided the pain, but he missed the gain, the very recovery that builds long-term wealth. Over the next 2 years, his smart moves cost him nearly $250,000 in lost growth. Here's what most people don't understand. The market's best days often come right after its worst. Miss just 10 of the top-performing days in a decade, and your overall returns can drop by more than half. Yet those days are impossible to predict. They arrive when fear is highest, when headlines scream chaos. By stepping aside, just until things calm down, you often step out at the exact moment when opportunity is greatest. Frank wasn't reckless. He was cautious and informed. But knowledge isn't timing. The economy, politics, interest rates, they all influence markets, yet none can forecast turning points with precision. Even professional fund managers with teams of analysts and decades of data fail at consistent market timing. For individual retirees, the odds are even slimmer. The emotional toll is just as dangerous. Every time Frank sold, he felt relief, confirmation that he'd protected his money. But each time he re-entered, it was with hesitation, waiting for the perfect moment that never came. This back and forth drained his confidence and created constant anxiety. Instead of enjoying retirement, he spent his days second-guessing every decision. The market became his opponent, not his partner. Timing feels powerful because it offers control in an uncertain world. But true control comes from discipline, not prediction. A well-diversified portfolio, regularly rebalanced, naturally adjusts to market cycles. You don't need to guess when to move, the process does the work. What destroys wealth isn't volatility, it's reaction. Selling low, buying high, repeating the cycle until returns vanish. Another client, Linda, made a similar mistake but in reverse. In 2021, when headlines cheered record highs, she poured extra savings into aggressive growth stocks. "Everyone's making money," she said. Months later, the market corrected sharply. Her portfolio dropped nearly 30%. She hadn't timed her exit, she'd mistimed her entry. Whether you move in or out too soon, the result is the same: losses that could have been avoided with patience. Timing mistakes often disguise themselves as prudence. "I'm just waiting for things to settle." But markets rarely settle. They move from fear to greed and back again. Waiting for certainty is waiting forever. The best investors don't predict, they prepare. They build portfolios aligned with their time horizon and stick with them through the noise. Let's put numbers to it. Suppose you invested $500,000 in the S&P 500 and left it alone for 20 years. Historically, you'd average around 8% annually, ending with over $2.3 million. But miss just the 25 best days, 1 or 2 per year, and your return falls to roughly 4%, cutting your ending balance nearly in half. That's the silent cost of stepping aside. Frank eventually learned this the hard way. After several cycles of selling and re-entering, he chose a different path. We built him a rules-based plan, 60% stocks, 40% bonds, rebalanced annually, no emotional changes allowed. He still watches the news, but now he lets the plan lead. It's a relief, he told me. I finally stopped trying to outthink the market. I just let time do the work. The timing genius trap doesn't destroy wealth all at once. It erodes it quietly through missed compounding. Every year out of the market is a year your money isn't multiplying. And for retirees, time is the one resource that can't be replenished. In the next part, we'll uncover a fifth timing error, one that creeps in subtly, even among disciplined investors, the withdrawal mismatch. It's the mistake of pulling income from the wrong investments at the wrong time, forcing you to sell low and lock in losses permanently. I'll share the story of a retired couple whose withdrawal timing cost them nearly 15 years of growth, and how a simple shift could have preserved their income for life. If you've ever sold investments to cover expenses, you'll want to hear this next. The fifth mistake is one that sneaks in quietly, even for disciplined, long-term investors who never panic sell or chase trends. It's called the withdrawal mismatch, and it happens when retirees pull income from the wrong investments at the wrong time. You may not even realize it's happening. You're simply taking your monthly withdrawals, covering your bills, and trusting that your portfolio will recover. But if those withdrawals come during a market downturn or from volatile assets, you're not just spending, you're locking in losses that can never grow back. And over time, this timing error can shorten the life of your portfolio by a decade or more. Let me share a story that still haunts me. Ellen and Howard, both in their late 60s, retired in 2019 with $800,000 saved. They planned carefully, a mix of 60% stocks, 40% bonds, and a simple rule: withdraw 4% a year for income. For the first year, everything seemed fine. Their portfolio provided $32,000, plus Social Security. Then came 2020. Markets plunged. Their account dropped to $660,000, yet their expenses didn't stop. They continued pulling the same $32,000 to pay bills, unaware that each withdrawal now represented a bigger percentage of their shrinking portfolio. By the time markets rebounded, their balance was permanently scarred. Even though prices recovered, they had fewer shares left to grow. The damage was subtle but lasting. 5 years later, their portfolio sat nearly $120,000 lower than it would have been if they'd paused or adjusted withdrawals during the downturn. Ellen told me, "We didn't panic sell. We just took what we needed." But that's the trap. Withdrawing during declines turns paper losses into real ones. It's called sequence of returns risk, the danger that poor early returns combined with steady withdrawals drain your account faster than math suggests. Two portfolios can earn the same average return, but the one that experiences early losses with ongoing withdrawals will run out years sooner. Timing isn't just about when you buy or sell, it's also about when you take. Think of it like slicing into a cake that hasn't finished rising. Each cut reduces the base that future growth can build on. In the market, every share sold to cover expenses during a dip is one less share to rebound when prices recover. You might not feel it in the moment, but over decades, it compounds into a shortfall that no amount of frugality can fix. There's another layer to this mistake: pulling from volatile assets instead of stable reserves. Many retirees keep all their money in one blended portfolio and sell proportionally each month. It feels balanced, but when stocks are down, you're selling at a discount. The smarter approach is to separate your money into time buckets: a cash bucket for 1 to 2 years of income, a conservative bucket for near-term needs, and a growth bucket for long-term compounding. That way, you draw from safety during downturns and give stocks time to recover. I once worked with George, a retired firefighter who started with $1 million. In 2022, his portfolio dropped 15%. Instead of selling investments to fund his income, he used his cash bucket, a year's worth of expenses parked in a high-yield account. By the time he needed to refill it, the market had bounced back. His balance recovered, his withdrawals stayed stable, and his growth engine kept compounding untouched. Same market, same returns, but his timing was different, and the outcome dramatically better. The danger is greatest in the first decade of retirement. Those early years set the trajectory for everything that follows. A bad sequence, losses combined with withdrawals, can create a hole that growth can't refill. You might still see average returns on paper, but your actual balance tells a different story. That's why timing income matters as much as timing investments. This isn't about avoiding withdrawals. You earned your retirement. It's about when and from where you take them. Having a plan that coordinates market cycles, cash reserves, and spending is the key. Without it, you're at the mercy of randomness, hoping the market cooperates exactly when you need it most. Ellen and Howard eventually made changes. We built them a 3-bucket strategy: 2 years in cash, 3 in short-term bonds, the rest in diversified growth. When markets dipped again, they drew from the safe buckets. Over time, their portfolio regained strength, and their confidence returned. "We finally stopped worrying about every headline," Ellen said. "Now we know where our next check is coming from, no matter what the market does." The truth is, retirees don't fail because of bad investments. They fail because of bad timing. Not dramatic mistakes, but subtle ones repeated over years: pulling from the wrong account, selling too soon, sitting out rebounds. Each act feels small, but together they shorten the lifespan of your wealth. In the next section, we'll explore a 6th timing error, one most seniors never see coming: tax timing. Many retirees focus on investment returns but overlook when and how their withdrawals are taxed. Taking money from the wrong account at the wrong time can push you into higher brackets, trigger Medicare surcharges, or cause unnecessary taxes on Social Security. I'll share the story of a retired couple who unknowingly paid tens of thousands in extra taxes, and how smarter timing could have turned those payments into extra income instead. If you've ever wondered whether to withdraw from your IRA, Roth, or brokerage first, you'll want to hear what comes next. The 6th mistake is one that hides in plain sight. It doesn't come from fear or greed, but from something far less obvious: tax timing. Many retirees focus on investment performance, asset allocation, and market cycles, but overlook how the timing of withdrawals affects what they actually keep. Because in retirement, it's not what you earn that matters, it's what you keep after taxes. And taking money from the wrong account at the wrong time can quietly drain your nest egg faster than any market dip. I've seen it happen to thoughtful, organized people who did everything right. They saved consistently, diversified their investments, and built solid portfolios. Yet every year, thousands of seniors pay far more in taxes than necessary simply because no one showed them how to time their withdrawals strategically. Take Jim and Carol, both 69 when they retired with about $1.2 million spread across different accounts: a traditional IRA, a Roth IRA, and a taxable brokerage. Their plan was simple: live off their IRA withdrawals and Social Security. It seemed reasonable. But by relying solely on their IRA for income, every dollar they took was taxed as ordinary income. In their first year, they withdrew $70,000, pushing them into a higher bracket and triggering taxes on 85% of their Social Security benefits. They also crossed the threshold for Medicare premium surcharges, adding nearly $2,000 a year in extra costs. They didn't do anything wrong. They simply pulled from the wrong bucket at the wrong time. If they had blended withdrawals, taking part from their taxable account and part from their Roth, their taxable income would have stayed lower, their Social Security would have remained largely untaxed, and their Medicare costs would have stayed flat. The difference? Over 10 years, more than $80,000 in unnecessary taxes and fees. That's the silent danger of poor tax timing. You don't see it on your statement. The losses don't show up as red numbers. They show up as checks written to the IRS, dollars that could have been used for travel, healthcare, or leaving a legacy. What most retirees don't realize is that retirement is a 30-year tax window. Once you start Social Security, take required minimum distributions, RMDs, and draw from various accounts, each move interacts with the others. The order and timing matter enormously. Withdraw too much too soon, and you accelerate taxes. Wait too long, and RMDs can push you into higher brackets later when flexibility is gone. The key is to think of taxes as another form of investment return. If you can reduce taxes by 2% a year through smart timing, that's the same as earning an extra 2%, risk-free. Yet few retirees treat it that way. Let me show you what smart timing looks like. During the early years of retirement, before RMDs begin at age 73, many retirees have a unique opportunity called the tax sweet spot. Their income is lower, but they still have control. By taking modest withdrawals from IRAs in those years, you can fill lower tax brackets intentionally, convert some funds to a Roth, and reduce the size of future RMDs. That means fewer taxes later and more flexibility when you need it most. Another strategy is Roth conversion timing. Many people wait too long, assuming they'll always be in a lower bracket. But tax laws change, and required distributions can balloon taxable income in your 70s. By converting gradually in your 60s, you pay taxes on your own schedule, often at lower rates, and create a pool of tax-free income for the future. Then there's capital gains timing. Selling appreciated investments during low-income years can allow you to realize gains at 0% or 15% instead of 22% or more. But if you layer those sales on top of big IRA withdrawals, you could push yourself into a higher bracket and lose the advantage. It's not about avoiding taxes, it's about controlling when you pay them. Jim and Carol eventually made adjustments. They began taking a blend of income, some from their IRA, some from their taxable account, and a small draw from their Roth for larger expenses. Their taxable income dropped, their Medicare premiums normalized, and they avoided RMD spikes later on. "We thought our advisor handled everything," Carol told me, "but no one ever explained how timing mattered. Once they understood, it changed everything." For retirees, taxes are like gravity. You can't escape them, but you can work with them. Without a plan, they'll quietly pull you down. With smart timing, you can reduce drag and extend the life of your savings. Here's a simple rule of thumb. In early retirement, before Social Security and RMDs, draw from IRAs strategically to fill lower brackets. Once Social Security starts, blend income sources to manage thresholds. Use Roth accounts for flexibility and large expenses to avoid bracket jumps. Always plan withdrawals with an eye on Medicare, surtaxes, and capital gains interactions. You don't need to be a tax expert, but you do need a coordinated plan. Taxes are one of the few factors in retirement you can truly control. Timing them well is one of the most powerful ways to protect your wealth. In the next section, we'll look at the seventh mistake, one that's more emotional than analytical: waiting too long to spend. Many seniors become so focused on preservation that they delay using their wealth until it's too late. I'll share the story of a man who saved diligently his whole life but never gave himself permission to enjoy it, and how better timing could have turned his savings into a richer life, not just a larger balance. The seventh mistake is one most people never see as a mistake at all: waiting too long to spend. After decades of saving, budgeting, and sacrificing, many retirees enter their golden years with a mindset shaped by caution. They spent their entire working lives building a nest egg, watching every penny, and now they struggle to shift gears. Even when the money is there, they hesitate. They delay trips, skip experiences, and live smaller than they need to. They think they're being prudent, but what they're really doing is letting time, their most precious asset, slip away. I've seen this countless times. People work 40 years to reach financial freedom, but when the moment comes, fear takes over. They worry about outliving their money, about market crashes, about medical costs. So they wait. They tell themselves, "Next year we'll travel," or "We'll upgrade the house later." But later doesn't always come. Health changes. Energy fades. Opportunities pass. And the memories they could have built are replaced by quiet regret. Let me tell you about Harold, a retired engineer who saved diligently his entire life. He lived modestly, invested wisely, and retired with over $1 million. Every year, I'd remind him, "You're in great shape. You can safely spend $50,000 a year and still grow your portfolio." But Harold couldn't do it. He'd grown up in a family where money was tight, and saving became part of his identity. He feared touching his principal. So he lived on Social Security and a small pension, leaving his investments untouched. He kept saying he'd travel once things settled down. He postponed the trip to Italy he'd dreamed of for decades. He delayed replacing his old car. He told himself he'd splurge when the market looked better. Then one spring, Harold suffered a mild stroke. His recovery was slow, and his mobility never fully returned. The trips he planned, the hobbies he postponed, all became things he talked about instead of lived. He passed away at 78 with over $1.4 million in the bank. Financially secure, Yes. But rich in experiences? Hardly. That's the tragedy of waiting too long. You spend your healthiest, most active years guarding money you may never need, and when you finally feel safe to spend, life's window has narrowed. Retirement is not just about avoiding poverty. It's about maximizing joy while you can still enjoy it. Timing your spending is just as important as timing your investments. The early years of retirement, your 60s and early 70s, are often your go-go years. You have the energy, the curiosity, and often good health. Those are the years to front-load experiences. Yes, you still need a plan for longevity and healthcare, but money is a tool, not a trophy. It's meant to serve you, not the other way around. Psychologically, the transition from saving to spending is one of the hardest shifts retirees face. Your whole life you were rewarded for accumulation. Saving felt responsible, spending felt dangerous. But once the paycheck stops, that instinct can turn into paralysis. You need permission, from your plan, from your advisor, and most importantly from yourself, to enjoy what you've built. I remember another couple, Rita and James, who approached retirement with the same fear. They had $900,000 saved and modest living expenses. They dreamed of taking their grandchildren on a family vacation to Hawaii but couldn't bring themselves to book it. What if we need that money later? Rita asked. We ran the numbers together. Even with conservative assumptions, they could afford it easily. The next year, they finally went. Afterward, Rita told me, it was the best decision we've ever made. We realized the memories were worth more than the balance. That's the balance every retiree must find. Enough caution to protect the future, but enough courage to live the present. A well-designed financial plan should tell you how much you can spend each year with confidence. If you don't have that clarity, fear fills the gap. But when you see the math, the sustainable withdrawal rates, the projected growth, the safety buffers, you can act without guilt. Delaying enjoyment also has hidden costs. Inflation erodes purchasing power. Travel becomes harder with age. Friends and family move or pass away. The opportunity cost of inaction is real. Every year you wait is a year you'll never get back. So how do you avoid this timing trap? First, create a written plan that includes lifetime spending projections. Know what you can safely withdraw each year without jeopardizing your future. Second, segment your retirement into phases: go-go, slow-go, and no-go. Spend more in the early years while your health allows it. Third, automate income. Set up regular withdrawals from your portfolio just like a paycheck. When money arrives predictably, you're more likely to use it. Finally, remember why you saved. You didn't sacrifice for decades just to stare at account balances. You did it to buy freedom, experiences, and peace of mind. Harold's story is a cautionary tale, but it doesn't have to be yours. The goal isn't to die with the most money, it's to live with the fewest regrets. Timing your spending is about aligning your wealth with your life's timeline, not just your lifespan. In the next part, we'll tackle the eighth and final timing mistake, the one that catches many families off guard: legacy timing. It's the failure to plan when and how to pass on wealth efficiently. Without clear timing and structure, taxes, probate, and confusion can consume what you worked for. I'll share how one family's delay in planning cost them hundreds of thousands in unnecessary taxes, and how a few timely steps could have turned their estate into a lasting gift. The eighth and final mistake is one that often isn't discovered until it's too late: legacy timing. It's not about how much you leave behind, but when and how you plan for it. Many retirees spend years building wealth but postpone the decisions that determine what happens to it. They assume they'll get to it later, or that their will is enough. But without strategic timing, in gifting, estate transfers, and beneficiary planning, taxes, legal fees, and delays can quietly consume a large portion of what was meant for loved ones. I've seen families torn apart not by greed, but by confusion. Assets stuck in probate. Beneficiaries fighting over unclear wishes. Accounts left untitled, trusts unfunded, and opportunities for tax-free transfers lost forever because planning happened too late. Let me tell you about Arthur and Joan, a couple who spent their lives saving carefully. They had 2 children and a modest estate worth about $1.5 million, a paid-off home, IRAs, and a small brokerage account. Arthur always said, "The kids will figure it out." He had a simple will and thought that was enough. When he passed unexpectedly, Joan was left to navigate everything. Some accounts still listed his deceased parents as beneficiaries. Their home was titled incorrectly, and because their IRA beneficiary forms hadn't been updated, part of the balance went into probate, triggering delays and unnecessary legal costs. By the time the estate settled, nearly $120,000 had been lost to taxes, court fees, and penalties that could have been avoided with timely planning. This is the cost of waiting. Legacy timing isn't just about estate documents. It's about proactive moves while you're still here. Every year, you have opportunities to shape how your wealth transfers, through gifts, Roth conversions, charitable strategies, and beneficiary updates. But if you delay, the choices narrow, and the control shifts away from you. Here's what most people don't realize. The best time to plan a legacy is not at the end, it's decades before. Taxes on retirement accounts, for example, are often highest for your heirs, not you. If you leave large traditional IRAs, your children may be forced to withdraw them over 10 years, pushing them into higher brackets. By timing Roth conversions during your lower income years, you can reduce their tax burden and turn a taxable inheritance into a tax-free one. Another timing element is gifting. Many retirees wait until death to pass assets, believing they need to hold on just in case. But for those with sufficient savings, gifting earlier, within annual limits or through a structured trust, allows you to see the impact of your generosity. You can help a grandchild pay for education, assist a child buying a home, or support a cause you love, all while reducing the taxable estate. The emotional return is often greater than the financial one. Then there's the issue of charitable timing. Many seniors plan to give to charities in their wills. But donating appreciated assets while alive can provide immediate tax deductions and avoid capital gains. Qualified charitable distributions from IRAs after age 70 and a half can satisfy required minimum distributions while keeping income off your tax return. The key is not just giving, it's giving at the right time. I once worked with Margaret, a widowed teacher who wanted to leave a legacy for her 3 grandchildren. She had $900,000 in savings and more than she needed for her lifetime. We created a plan. Each year, she gifted $10,000 to a 529 education plan for each grandchild, plus small annual charitable donations using appreciated stock. Over 10 years, she reduced her taxable estate by over $300,000, saved thousands in taxes, and lived to watch her grandkids graduate debt-free. "This is what I worked for," she said. "Not just to leave money, but to see it do good." That's what good timing makes possible. Without timing, even well-intentioned plans can backfire. Suppose you hold appreciated assets in a taxable account and sell them late in life to clean things up. You'll pay capital gains that could have been avoided. But if you hold those assets and pass them at death, your heirs receive a step-up in basis, wiping out the gain entirely. The difference between selling in haste and transferring strategically can mean tens of thousands of dollars. Legacy timing also protects your loved ones emotionally. When you clarify intentions early, update documents regularly, and coordinate with beneficiaries, you remove uncertainty. You turn potential conflict into clarity. You ensure that your story, not confusion, becomes your final gift. If you haven't reviewed your estate plan in the past 3 years, checked your beneficiary forms, or coordinated your tax strategy with your legacy goals, now is the time. Don't leave it to chance or to courts. A few conversations today can save your family years of stress tomorrow. Retirement isn't just about accumulating wealth, it's about orchestrating it. Each stage has its own timing. When to invest, when to shift, when to withdraw, when to spend, and when to pass it on. The retirees who thrive aren't the ones who guess the market right. They're the ones who align their money with the rhythm of their lives. You've worked decades for what you have. Don't let timing errors, in markets, taxes, or legacy, rewrite your story. The right plan, guided by patience and foresight, turns your savings into security, your security into freedom, and your freedom into impact. So take the time now to check every piece: your investment mix, your withdrawal plan, your tax strategy, and your legacy documents. Because wealth isn't measured by numbers alone, but by how well it serves your life and those you love, while you're here and long after you're gone.